You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Ever looked at a stock and wondered, is now actually a good time to buy? We all hear buy low, sell high. But what does low really mean in the world of investing? In fact, when you Google a company like Google, you'll see something called the P/E ratio, which is a key multiple investors use. A 2022 CNBC survey reported that over 85% of retail investors rely on P/E ratios to make their initial screening decisions. Here's a case. Imagine Plain Bagel Company has a P/E of 15, calculated by dividing its 30 share price by its 2 earnings per share. It's like comparing price per pound at a butcher. Multiples help you see what you're really paying for. But some might say, aren't these ratios just arbitrary numbers? It's true. If you only look at the P/E, you might overlook industry differences or company growth rates. Context is everything in valuation. So next time you see a P/E ratio, consider it a starting point, not the full story. Always ask what the underlying business fundamentals tell you before making a move. Is the past or the future more important when valuing a stock? That's a question every investor faces when looking at multiples. A recent Morningstar study found that forward P/E ratios are used in over 60% of analyst reports, reflecting how much weight markets place on future expectations over historical results. Consider Plain Bagel Co. again. If analysts expect its profits to rise from $2 million to $2.5 million next year, its forward P/E drops from 15 to 12. This shift can signal opportunity if those forecasts hold. Skeptics might argue, aren't forecasts just educated guesses? Absolutely. And that's the risk. If those projections miss, the forward multiple can mislead investors into overpaying. The practical takeaway? Don't rely solely on forward multiples. Use them in tandem with historical data and industry trends to make well-rounded decisions. If a stock's P/E is lower than usual, is it a bargain or is something wrong? The answer lies in comparison, not isolation. Research from Fidelity shows that stocks trading below their 10-year average P/E tend to outperform by 2% annually, but only when their industries remain stable. Let's say Plain Bagel Co. has a current P/E of 12, below its 10-year average of 15, but its peers, Sesame Sands and the Cagle Bagel, averaged just 10. So, while the stock is cheap for itself, it's pricey compared to competitors. Some investors claim low multiples always mean undervaluation. But what if the company's prospects have declined? The low price might be justified by real risks, like impending regulation or changing consumer tastes. To apply this, check both the stock's history and its industry. Only then can you spot true bargains and avoid falling for value traps. Is buying a cheap stock always a smart move? Not necessarily sometimes. Low prices hide deeper problems. A 2021 academic review found that about 30% of so-called cheap stocks, those with low P/E ratios, became value traps, continuing to underperform due to deteriorating fundamentals. Imagine picking up a 3 steak, only to find it expired and inedible. Similarly, if Plain Bagel Co. faces declining demand due to keto diets or regulatory hurdles, its low multiple might reflect real trouble ahead. Critics will argue, isn't any discount worth a shot? But a low multiple alone doesn't guarantee upside if the company's long-term prospects are compromised. The actionable insight: focus on fundamentals first, then use multiples as a sanity check. As Buffett says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price.